You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koos, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everyone, welcome to my home. This is the basement, we'll call it the Koos office and music studio. But the reason I'm jumping on here before we officially start the podcast is to apologize in advance for the poor audio quality. We had some issues with audio quality where the mic gain was, for some reason, turned up too loud. So you're going to hear everything that I'm saying just fine, but it's going to be a little bit distorted. But I did want to apologize for that in advance. So without further ado, let's go ahead and move forward with this week's podcast on risk management.
Hello everyone, it's Friday, and today we're talking about one of the most important, if not the most important part of investing, and that's risk management. It doesn't mean a whole lot to a lot of people, but it's probably more than security selection, investment selection, allocation. It is, when it comes to managing your money and investing, it is probably the most important thing above all else. Now, if this is your first time listening or watching, then thanks for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is that for you, that you learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often, subscribe on both iTunes and YouTube, and please note that all links, visuals, charts, and other educational resources can be found on our website at libertaswealth.com. All right, let's go ahead and get started into the meat of the conversation here. So we're talking about risk management, managing risk. We're talking about protecting our portfolio, protecting investments that we buy, whether that's buying an investment, seeing it go up and not losing the entire gain, whether that's buying an investment and seeing it go down immediately. One of the things that investors have a tendency to do, it's counterintuitive, and it doesn't make any sense whatsoever, but we are emotional beings. When investors buy investments, when humans buy investments, if they have two investments and one's up 20% and one's down 20%, what humans tend to do is they tend to sell the one that's up 20% and leave the one that's down 20%. That might make sense because you think, oh, well, I made money on the one, I can lock in those gains, and I want to take that 20% loss and I want to hold on to it till it comes back. The problem is sometimes it doesn't come back, or it might take so long to come back that you're wasting good hard-earned money when you could have otherwise just sold the investment, taken a tax loss, let's just say, and used that money for something else that had better prospects for growth. So I always like to start with quotes. So when we're talking about risk management today, the first quote I want to share with you here is this one by Robert Kiyosaki. It says, "It's not how much money you make." So again, it's not about how much money you're making, but how much you keep, how hard it works for you, and how many generations you keep it for. And I just think that's a beautiful quote. Another one here that's also applicable, and this is just something that I say a lot here at our office, but I always say before you ever invest in anything, you should always first know the point at which you would sell it. It's kind of like your puke button, the point at which you say, you know what, I quit, I can't take it anymore, I want out. Now, this should all be obviously in conjunction with a financial plan. It should all be in conjunction with working with a financial professional. I do believe that it's possible to manage all this stuff yourself. I'm not one of these people that say you can't do it yourself. You can. I always say you have to have two things. A, you have to have the interest, and B, you have to have the time. If you're not interested, you're not going to spend the time on it, and if you don't spend the time on it, you're probably not going to like the results. So it's really, really important that, and if you're not somebody who likes this stuff and or don't have the time for it, that you're working with somebody who is a professional, that does know what they're doing, that does spend time on it all day, every day, so that they can help make sure that you're hitting your goals, make sure they understand your risk tolerance, make sure that they have a financial plan and a retirement plan in place for you so that they know exactly how much risk they should be taking to begin with, not to mention what kind of strategy or strategies that you should be implementing into your retirement plan. So, what is risk management? Let's talk about that. So risk management can be done in one of two basic ways. Now there's more ways than this, but we're going to keep this surface level as best as possible anyway. So there's tactical risk management and there's strategic risk management. Tactical risk management is where you're actually getting out of the investment, selling it, maybe going to cash. You might sell several investments or an entire portfolio of investments, and you might go to risk-free investments or perhaps just lower risk investments like treasuries or short-term securities like bonds. Strategic's a little bit different. Strategic is where you're not using the market environment to increase or decrease the levels of risk or taking risk off the table. You're not necessarily selling your investments and putting it on the sidelines when the going gets tough in order to protect your portfolio. It's more rotating in and out of investments in order to stay in an allocation and then managing the risk based on that allocation. So for instance, with strategic investing, you would have, say, an aggressive portfolio. Obviously would be a very aggressive investor. That portfolio is going to rotate out of the investments that are underperforming, that are showing or exhibiting lower, what we call relative strength, and what's going to rotate into the portfolio is going to be stronger investments exhibiting stronger relative strength. But over time, you might not own, like for instance, right now, you might not own any financials or energy because they're horrible investments to own today, and they have been for months now. Actually, with energy, it's been years. But with strategic investing, what's happening is you're rotating out of the laggards, rotating into the leaders, staying with that leadership for as long as it lasts. And when the market changes, that rotation continues, and that's how the risk is managed on one hand. On the second hand, when it comes to strategic investment management, the other way it's managed is through the kind of model you're in. So if you're an investor that would consider yourself very conservative, a strategic investment plan, while being invested all the time in an asset class sector rotation fashion, would be invested in a conservative model that, let's just say, doesn't go much more invested than, say, 35%, maybe 45% on the high end into stocks, whereas the rest of the portfolio, the other 65% or so, is invested primarily in fixed income investments, bonds, money markets, cash, depending on the strength of the market at the time. So those are the two different types. So again, strategic, we'll start with what we finished with there. Asset class rotation, sector rotation, it doesn't manage risk based on the market environment. It manages risk based on the model you're in, either more conservative for conservative people or more aggressive for more aggressive people. Whereas tactical investments not only do the sector rotation thing, they not only do asset class rotation, of course, staying with relative strength, staying with the stronger investments, but what it also does is it's using the nature of the market landscape, risk-reward ratios to determine whether or not certain things should be bought or sold. And we're going to spend a lot of time talking about that here as compared to strategic. But let's talk about strategic first. So what is asset class and sector rotation? Let's explain that. And I think the best way to explain it is a friend of mine, Julius de Campanere, invented this unbelievably beautiful chart or graph, which those of you who are listening on iTunes, check this out on our website at libertaswealth.com. It is the best visual for understanding relative strength and asset class rotation, sector rotation, or rotation within an index than anything I've ever seen in my career. The relative rotation graph works like this. If you're looking at the screen, and I'll try to explain it in words for those of you that are listening on iTunes, is upper left quadrant. You've got a square here. So the upper left quadrant, so there's one big square and it's broken down into 4 squares. And upper left, you've got improving versus the market, and the market, by the way, is the middle. So the S&P 500 would be literally the 0 point and then the very, very middle of this box. Then you've got improving versus the market, you've got leading the market, or in other words, doing better than the market. You've got weakening versus the market, so starting to lag, and then you've got lagging, which is just generally just underperforming the market. And what you'll notice if you look at this chart, this relative rotation graph, or RRG chart for short, is that the stocks on the S&P 500, and this is all 505 stocks you're looking at here, are rotating in clockwise fashion. So they rotate, generally speaking, from lagging to improving to leading to weakening to lagging again. And so this is proof that asset class, sector rotation, industry group rotation, that the strength goes through cycles and that it does rotate. Every time one of these dots here, or the arrow moves one dot, that's 1 week, by the way. And we can turn this into daily, weekly, monthly. It doesn't make a difference. But here's the statistics, and this is where things get a little, for me, even more interesting. Whenever a stock is in the leading quadrant, there is a 92% chance that it moves to the weakening quadrant. And that is extremely high probabilities. If it's in the weakening quadrant, then there is a 62% chance that it moves to lagging, a 0% chance that it moves directly over to improving, and only a 38% chance that it moves back to leading. But it does move back from weakening back to leading again quite a bit. In fact, that's typically a good signal of an investment that's doing well, is one that went from improving to leading, back down to weakening, but comes right back up to leading. Then you've got lagging. So when stocks or investments, ETFs, what have you, indices are in the lagging quadrant, there is a 90% chance that when in the lagging quadrant that the investment moves to the improving quadrant. Only a 5% chance that it goes back to weakening or to leading, again, directly across the graph. And then last but not least, when it's in the improving quadrant in the upper left, there's a 68% chance that it moves to the leading quadrant, while an only 32% chance that it goes back down to lagging again. So these odds are extremely high, and I hate to use the word odds, but because what we work in here when it comes to investing are probabilities. I mean, and that's all we have. We have history, and we have studies, and we have probabilities. And this was a study that was done by Optima, the research software that I use, and where we used 20,000 trials or 20,000 rotations. So it's a big sample size, and I think it's a really, really interesting study that shows, again, that sector rotation, asset class rotation, that investments, in a sense, do rotate from outperformance to underperformance and back over time. So again, just to kind of close out here with strategic investment management, what we're doing is we're investing in the strongest asset classes, so that might be bonds today, maybe bonds and then U.S. stocks. And then what we want to do is we want to drill down into those asset classes, and we want to buy the best bonds or the best sectors and industry groups and stocks inside the U.S. stock market. So right now we wouldn't probably want to own energy, or at least if we own energy, we want to be very careful about what we own in the energy sector. So, solar has looked really good right now. Things in the lithium, companies that deal with batteries have been doing well. But as far as oil goes, gas, not so much. So I hope that makes sense. And if you do have questions, in the interest of keeping this, again, service level, 30,000 foot view, please email me if you have any questions or want more details. But let's move on. Let's talk about tactical, because I've got a few more slides here that I want to show you. But for the people listening, what we're going to talk about is a few different types of exit strategies, or a few different types of ways to protect your money in the case that things don't go so well, whether that's because you own a stock and you need to get out of it because things have turned for the worse, whether that's because you own a basket of stocks like a mutual fund or an ETF and things are turning for the worse and you don't know where to get out. If you own I don't know, any investment that you own, as I mentioned earlier, you should, if you're going to be tactical, and not everybody is with all of their money or part of their money, but if you're going to be tactical with some or all of your money, then you need to know where you're going to sell an investment before you even buy it. Otherwise, you just won't sell it because your emotions will get involved in your decision-making process, and you'll freeze, and you won't have the ability to make a decision at all. So let's talk about stops. There's three different types of stops that I'm going to talk about today. There's percentage stops, which are very simple. Support stops, which I'll explain a little bit more detail. And then there's what are called trailing stops that are kind of like support stops, but they look the same anyway. But there's different ways to do it, several ways actually. And I'm just going to talk about two. So let's first talk about percentage stops. So percentage stops are super, super simple. All it is, if for those of you on iTunes, we're looking at a chart right now, and I'm looking at gold, the GLD, which is the ETF that you can invest in to buy gold, which we do own right now, by the way, is you could buy it. Let's just say you bought it right here. So the investment goes down, up, and kind of goes sideways. It coils sideways, and then say it breaks out above this, what we would call a ceiling of resistance. So all these highs kind of form a ceiling in the past or the near-term past. If we bought it right there, then what we might say as a risk management strategy or an exit strategy to manage our risk and manage our exposure to this investment is we might say, well, I'm only willing to take a 6% loss or 6% risk, so therefore my percentage stop is I'm going to sell it if it falls 6% below my purchase price, and because that's all I'm willing to risk. And if that's the case, you put a line in the sand, you put an alert down, you say, okay, when this hits 6%, it'll let me know, and then I'm out. No questions asked. Now, that's super, super simple, and I think it works in some situations. Sometimes certain investments might be more volatile than others. So one investment might go up and down on average, say, I don't know, 0.75% per day, or its range might be very narrow. We call that the average true range of the stock in question, and how much it moves, how volatile it is. But another stock might move a lot. Like some biotech and pharmaceutical stocks have a tendency to move big. They can have huge up days, huge down days. So using the same percentage stop for every investment doesn't always make the most sense, because different investments act a different way, just depending on the nature of the investment, the sector, and so on. So here, this is the next example is a support stop. And for those of you listening on iTunes, this is a chart, and all I've done is I've taken the same gold chart and I drew a big line below the most recent major low. And that line corresponds pretty closely with another low that occurred about 6 months prior to the most recent low. So we would call this line in the sand support, or like a floor of support. And the support acts as a psychological point below which many investors, if they purchased it in that area, might want to click the sell button themselves and might want to get out. Furthermore, there might be investors that are waiting for the price to get back down to that level before they buy it. And if that's the case, it might cause the stock to go up in value, or the ETF to go up in value. In this case, this is gold. So ironically, in this case, and I didn't do this by design, by the way, I just pulled up gold because it was the first chart I looked at, but the percentage stop that we used in the prior example of 6% just happens to correspond pretty closely to the most recent low and previous major low in the GLD in gold. So this might, and by the way, whenever you see kind of convergences like this, when things come together and you say, well, the most risk I'm willing to take is 6%, and oh, by the way, it also happens to coincide with a major level of support from a prior point on the chart, that actually adds more validity to the exit strategy. So, if the stock comes down and it starts to bounce and head right back up again, what that tells us is that there are more buyers at that point, and that buying or demand is in control. If things broke below that level, though, and we're not be able to reclaim that line, so if it broke below that line and then headed back down again, then that would obviously be a bad thing, and that would show us that supply is in control, or sellers are in control of the market. So this is one kind of support stop, or just an example of one, I should say. The next picture I'm going to show you a bunch of stops. And this is also the GLD. It's a little bit more recent chart of gold. But here you can see I just drew lines at different points at which people may have used in the past, or you could use for levels of support below which you may not want to own this investment anymore. So before you buy gold, you might say, well, I'm not going to own it if it crosses below this level. And the reason why you might do that is because it would create a lower low. We want to see a positive trend is very simple. It's higher highs and higher lows, and that's it. So we want to see investments going up, creating higher highs, higher lows, not creating lower lows and lower highs. So you can see on the chart here that we get a higher high, higher low, we get another higher low here, another higher low here, and then all of a sudden we get a breakdown. Now, in hindsight, we can look back and say, oh, well, that breakdown was pretty short-lived. It only went down for a little while, and then it headed right back up again. But still, we didn't know that at the time, right? And by the way, I didn't own gold at that point, and we didn't own it for our clients. But my point is, we could have, and if we did, I can't predict the future, and I would have no idea what's going to happen in the future. So, of course, well, you can't predict the future, so you have to manage risk, right? That's the whole point of this podcast, I guess. So you might have been able to use, if you were more, maybe wanted to give it more room, or if you were willing to lose more money or take more risk, you might have said, I'm willing to hold this to the December 2016 lows, in which case you never would have gotten out of it. You would have stayed in. Now, at some point, you probably want to raise your stop loss. You want to raise the point at which you would get out, that line in the sand. So here, you might raise it here. You might raise it here to the 2020 levels. So, but the point is, as long as the market or an investment you own, or in this case, gold, creates higher highs and higher lows, then the investment's okay to hold on to. It's when that changes that we need to obviously change our stance if we're a tactical investor, if we want to manage risk in this fashion. And here's an example of doing just that in 2008. So one of the things that you could look at in 2007, 8, and 9 was the I'll just say the August lows going into the end of the year. We had a very, very similar low there at the end of 2007. And then all of a sudden it broke down. So that was your first warning sign that maybe things weren't going well. Again, we couldn't predict the future. All we can see at this moment in time in 2008 in January is this breakdown below that support, that floor of support. So what was potentially support is now officially become support, right? It's broken through that level. Now you've got another major low here. You could have used this one as well, but you've got a major low in March of 2008. And you say if you get back into the market, let's just say, or if you never sold to begin with, you could hold on and you could say, what, if we break below that level, then I'm getting out. That's your risk management. I'm not willing to lose more than that line in the sand. And here it breaks down. And the funny thing about the psychology here is that when it breaks down like this and you sell and then you start seeing it come back, it messes with your mind. It gets you thinking, well, maybe I shouldn't have gotten out. It's coming back right now, and that those emotions cause you to make poor decisions, and that's why it's so important to have rules in place to whatever plan, whether you're using strategic, whether you're using a tactical, or a combination of the two strategies. You need to just stick to the plan and stick to the rules, because otherwise your strategy is going to be all over the place, and really you don't have a strategy if you don't stick to the rules, right? It's like playing a game but changing the rules all the time. So this last level of resistance here, support, the floor below our feet, which I could have drawn more here, let's say 4 total, but I've got 3 on the chart here. This goes back to the August lows in 2008. It broke below those August lows in October and going into November, and it was just, the market just tanked from there. So there was several opportunities below which we could have said, you know what, I'm just going to wait this out, sit on the sidelines and see what happens before I take any risk at all at this point. And that could have obviously helped us quite a bit. So that's we talked about percentage stop. It was the first one we talked about. We talked about support stops. Now let's talk about what's something called trailing stops. Now the trailing stops I'm going to use here today are what are called moving averages. It's the average price movement over a given look back period. The one we're looking at on the screen right here. So we've got the 2007, 8, and 9 market in black. And then we've got the red, which is the 200-day moving average, or it's the average movement of the S&P 500 over the last 200 days. And you can see here, if you used this line in the sand, the 200-day moving average, which many people do, by the way, many institutions do, many funds do, as your line in the sand, then in late 2007, you'd have been out, in, out again, in again, out again, in again, and out again. So you basically would have had 5 round trips. 1, 2, 3, 4 round trips where you've gotten out 5 times before you finally stayed out of the market, which can again mess with your mind and mess with your psychology and make you think that maybe this isn't working, or maybe I shouldn't be doing this, because it can cause what are called whipsaws. You know, it can cause you to sell and then sell low and then buy high, and then sell low and buy high. But ultimately, when it's kind of like driving a car. For those of you who've ever driven a stick shift, when you're driving a car and things start to go, you push the clutch in, the car slows down periodically, or for a brief moment in time, until you put the next gear in, so go from first to second, and then you let the clutch out and you hit the gas, you start speeding up again. That's these moments of transition, just like shifting a car, can kind of be a point at which, whether you're decelerating, we'll call that the analogy for the market going down, or accelerating when the market's going up and coming back out of a downtrend. There's going to be some whipsaws, and there's going to be some times when it doesn't work out in the short term, but in the long term, the goal here is to protect risk, protect our minds, protect our psychology, and make sure that we're not abandoning our financial plan, our retirement plan, because at the end of the day, that's really what's most important. So this is a 200-day moving average. Below it is bad, above it's good, and you can see here in early 2009, you're back in. If you use this line in the sand, you're out again, you're in again, you're out again, and then you're in again. So you had basically 3 times you have to get out, 2 times you have to get, 2 times you're out, 3 times you're in, and finally we're off to the races, and we're hitting the 2009 bull market, or the beginning, I should say, of the 11-year second longest bull market in history. So the next trailing stop I want to share with you is something a little faster. This is a 21-day moving average. So a 21-day, this is an exponential moving average for the nerds out there. It's not a simple moving average. So a 21-day moving average is just like the 200, except it's instead of 200 days of average movement, it's 21 days. So all we're looking at is 1 month, because there are 21 trading days in a month. So here's a stock called Fastly, and here, if we would have bought this stock, let's just say somewhere around this area, close to this 21-day moving average, which means our risk is very low if we plan on selling it below that line, and our reward is potentially very high if it continues to go up, then we could use this 21-day moving average as our line in the sand to sell it. And you can see here how buying it somewhere kind of in the sideways movement here before it starts to break out, or as it breaks out, would have given you an opportunity to make a nice little chunk of change on the upside here. And while here it crossed below the 21-day, so as soon as it crossed below the 21-day moving average, you might have said, you know what, I'm out, I'm selling it. This is a nice gain. I'm taking my money to the bank, and I'm going to live to trade another day. And it happened twice. Sorry about that. The market just closed. So it happened twice here in the course of just a few weeks. So you might look back and go, oh, it went higher. I should have kept it. But you can't play that game with your psychology, because you don't know what's going to happen to any stock or the market or an ETF or a mutual fund. You have no idea what's going to happen to this investment tomorrow, next week, next month. So what we're doing is we're managing risk. Remember, it's back to the title of this whole podcast. We want to stack the deck in our favor. We want to buy investments that are going up ideally. We don't want to be guessing when they're going to go up or buy them when they're going down. What we call that catching a falling knife. It's a good way to get your hand cut up. We don't want to try and guess the bottom. We want to buy investments that are already showing strength. And then we want to put risk management levels in place, in the case of a tactical strategy, that is, to get out of that investment once the trend has ended, or it looks like it has ended. Even if it hasn't, even if it's wrong and it has not, let's just say it keeps going up, that's okay. There's nothing wrong. As Warren Buffett once said, nobody ever goes broke taking profits. So that's a 21-day moving average. The last one I'll show here, and this is quite nerdy, so I'm going to keep it super short, is I mentioned earlier that some investments are more volatile than others. And so some investments can go up and down in big up days, big down days, whereas other investments are kind of more slower and steadier. Well, this is what's called an ATR stop. An ATR stop stands for average true range, where it takes the previous day's close, today's open and closed. Basically, it takes three open, close from yesterday's market, today's market, and it puts it together. It removes all the gaps, so you don't have these gap up, gap downs, and then it smooths it out based on the volatility of the stock in question or the investment in question. So this can work on an ETF. It can work on an individual stock. And there's a couple things you need to enter to make this work right for you. And this is definitely much more advanced, by the way. But you can see here how in the case of Fastly, that in this case, the ATR stop, or the average true range, which manages for volatility, would not have stopped us out. In other words, we would not have sold it. We would have held on to it. Of course, what that means is the more room or the more cushion you put below any investment that you buy. So think of it like, that risk level, the risk you're willing to take, the more room below your purchase price, then the higher loss you're going to take if it doesn't work out, if it doesn't work in your favor. So, and again, that's when it goes back to managing the risk based on your personality, who you are. And I guess that's what we'll close with. So again, there's just in summary, two things. First, there's strategic asset class sector rotation, stays exposed to the market, avoids those whipsaws that tactical does not avoid, and then your risk is managed by the model you're in. So you stay conservative all the time, but you're invested all the time. You stay aggressive all the time, but you're invested all the time. Tactical risk management does the same sector rotation, asset class rotation, but it adjusts the exposure to the markets, whether that's stocks, bonds, commodities, and so on, up or down, depending on the risk levels in the market and the risk-reward landscape of the market. And the last 2 points I want to make here before we close out are that there are many, many ways to implement risk management. I've just talked about two of the main ways today, but it all depends on your time frame, age, net worth, spending habits, personality is important, and of course your financial plan output. If we don't have a financial plan in place, we're just kind of investing and we're hoping we have enough, and hope is not a strategy. And then last but not least here, no risk management strategy is perfect. There is no such thing as the silver bullet investment strategy that works all the time, that keeps you from ever losing money, and every investment always goes up when you buy it. It's one of my jokes. I always say that, I never really thought about it, but I ought to just buy stocks that go up. Of course, it's easier said than done, right? But so no risk management strategy, no portfolio management strategy, no retirement investment management strategy is perfect. But the key is to pick a philosophy that works for you. And if you can't pick one philosophy, pick a couple. So that's all we've got today. Feel free to share this podcast with your friends and family. And if you'd like to discuss your personal situation further, please remember you never ever have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting with us, head over to our website to schedule something in our calendar. And as I always say, there are thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates, as well as other screencasts, videos, and articles delivered directly to your email inbox. Feel free to follow us on Facebook. I'm also on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. So thank you again so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.